Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, December 1st, 2023. Last week, I revised the personal finance model portfolio to reflect my expectations for the coming year. I increased our allocation to bonds to 40% while reducing our exposure to inflation hedges and cash to 10% each. I left stocks unchanged at 40%. And up here on the screen, I have a copy of that article for you called Back to Normal. If you haven't read it yet, I recommend you just take a quick look at it. I said in that article, a 40-40, 10-10 allocation among stocks, bonds, hedges, and cash implies an historically normal economic environment. The economy has been so historically abnormal for the past 4 years that we've forgotten what normal looks like. I went on to note that the earnings yield of the S&P 500 index is now very close to the yield on the 10-year Treasury note. Now, if you're not familiar with earnings yield, it's simply the inverse of the PE ratio. So, for example, if the PE ratio on the S&P 500 was 20, then the earnings yield would be 5%. If the PE went up to 25, the earnings yield would be 4%. And right now, both the 10-year Treasury note and the S&P 500 index are around 4.5% each, roughly. And that means the risk-adjusted returns for both asset classes are about the same. So here I'm going to show you the S&P 500, and here it is year to date, and you can see it's now right about almost caught back up to where it was back at the end of July. In the short run, that'll make it difficult for the stock market to keep rising since income investors no longer feel compelled to own stocks. When interest rates are much lower, many income investors abandoned bonds in favor of stocks. But now that bonds are paying a decent rate of interest, income investors no longer must rely on the stock market to achieve their investment returns. You know, a few years ago, if you were an income investor and you needed to get a 4 or 5% return on your money to, meet your income needs or what have you, it wasn't there in the bond market. Treasury yields, the Fed was in its zero interest rate policy mode, after COVID, pushed interest rates down as low as they could. And a lot of income investors felt like, okay, I guess I got to go in the stock market, which was part of the reason why it rallied so strongly in the aftermath of the outbreak of the coronavirus pandemic. Now, in the long run, a balanced stock and bond market is good for everyone. We're less likely to experience the type of boom and bust stock market cycles that have recently been through. Instead, we will most likely see more consistent performance with less deviation from the mean. In other words, reduced volatility. That's a good thing because volatility tends to scare investors out of the stock market when it's in correction mode. Typically, they sell out near the bottom of the correction and then wait until it is fully recovered before getting back in. And in the long run, that type of behavior can significantly reduce returns. So let's look at, say, the S&P 500 index over the past 5 years to include, prior to the outbreak of the pandemic. You go back here to early 2020, S&P 500 index dropped, I think it was about 40% in a matter of less than a month. A lot of investors bailed out here near the bottom, and even when it recovered, didn't really start to trust it until it was well above where it was prior to the pandemic. Well, they lost out, on this point up until there. Then again, we had a similar, although not quite as extreme, drop early in 2022 when the Fed started raising interest rates. And again, steady slow down, a lot of people bail out, and some of those people still haven't gotten back in. But if you look at the big picture, they've missed out basically from its peak just before the outbreak of the pandemic to where it is now. And that's a significant amount of performance that's been missed. I bring that up now because the stock market had a great month in November. Now I'm going to go back to year to date and just show you how great November was. Right over here, it literally bottoms out on about the last day of October, close to it. And then you can see a very sharp upward turn. Over the first 4 weeks of this month, the S&P 500 index gained 8.6%. That's close to its average annual return, around 10%. Year to date, the index is up 19%, which is nearly double its annual average. Don't be surprised if the stock market backtracks a bit in December. And don't panic either. Some reversion to the mean is normal and, in my opinion, likely, given how quickly the stock market has reversed direction over the past month. 2 years ago, I said that I believe that even if the Fed is able to bring the economy in for a soft landing, it would probably come close to skittering off the runway with the plane rocking back and forth until it comes to a complete stop. I believe we are reaching the conclusion of that metaphor, but it won't be over for at least a few more months. Until then, stay strapped into your seats and enjoy the ride. Thank you, and I look forward to talking to you in another week.